This meeting is being recorded.
All right, hey, welcome back to Principles of Accounting 2. Still your host, Dr. B. Happy to have you with us. Fall 2024 semester is well underway. We are in week 10 already, if you can believe that or not. I was just thinking about this earlier. The time is flying by, isn't it? We are really going by quick now. We made it to week 10 already. There's only a couple of weeks left, if you can believe that or not. So, here's what's going on. And by the way, I just want to say thank you to start with because you're all doing extremely well in this course, and it's a testament to all of you. You're doing all the work. You're getting it in. Last 2 weeks we had those QuickBooks LinkedIn Learning certificates, and it's been a lot of work, but you're doing very well, and so I wanted to say thanks. For this week, we are going to be talking about budgeting concepts, the master budget in particular. And before we jump into that lecture, I just wanted you to know that to accompany this lecture, there is a discussion board for this week. Is to accompany the chapter. So those are your two action items for this week. You have the week 10 discussion board and the chapter 22 quiz. And they're both related to budgeting and the budgeting process. So let's jump into our conversation on budgeting. And we'll talk about why it's so important. I'm going to talk about my real life experiences related to budgeting from a work perspective related to hospitality. I know that a few of you are hospitality majors, and so I think that you'll find this conversation to be relatively enlightening as it relates to maybe something you might be doing in the near future. So let's talk about budgeting and planning. The reason why budgeting is so critical in business and in life is that it gives us a plan. It tells us exactly how much we got, how much we're going to spend on each line item, and it gives us permission to spend. That's why budgeting is so important. We look at budgets from business, yeah, but it's also from a personal perspective. I have an idea how much we're going to make each month, how much money is coming into the house each month, and I know how much my monthly expenses are. Therefore, I can budget for that month. And I do it for every month of the year. And for me, I like the rolling budget. I like planning 12 months out. Okay? In your household, you might do something similar. You have an idea how much is going to come in. You know how much is supposed to go out. And it gives you an idea month to month of what's going on, right? It's really good to have a written budget for both your personal life and it's critical for the business life, okay? But that's why budgeting is so important. It helps us to prepare for the future. Okay? Now, because this is Principles of Accounting 2, you know that we're going to talk about budgeting, but we're going to look at budgeting from a manufacturing perspective in order for us to understand how to create the budget for things like raw materials, labor, and overhead. Okay, having budgets for those things are really important. Yeah. So let's talk about the budget, the budgeting process, the benefits, all those things. So one of the first benefits I told you about was it gives us the ability to plan. It's beneficial for that reason, right? A budget is a plan for the future. That's what it is. It gives us an idea of how much we're going to spend, where we're going to spend it, why we're spending it. All those is a part of the budget. So how do we create the budget? We get a committee of people together in the company to help us to establish the budget. One example from my life in this process is from the hotel business. As a financial controller of a very large hotel property, I had a bunch of managers, okay? And these managers, each manager managed their own department. I had the food and beverage director. I had the restaurant manager. I had the front of house manager, the back of house manager. I had the rooms division manager. I had the maintenance manager. I had the sales manager. What am I missing? There's probably a few other ones. But thinking about a hotel, just the hotel building itself, you walk into that building and you see a lot of different departments, a lot of different managers. That's my committee. That's my committee, all the managers, okay? So the way it would work would be like this. I'd call all the managers up and say, hey, let's meet on Tuesday at 9 a.m., get everyone together in the conference room, and let's hash out the budget process. And so the way it would work is we'd all get together, sit around the conference table, and I'll tell each individual manager, this is the amount of revenue from sales of rooms and banquet, etc., that we expect to get for this year. Okay? Based off of the amount of revenue, sales, we expect to make, we can prepare the individual budgets for each department. And I would allocate percentages of the revenue to those departments. So that way we can figure out line by line which each department needs. So that's the plan. That was the plan. Then I'll get everyone together. I'd tell them that information. They'd come back to me a week later, say, here's my budget for my department. And I'll bring all of those individual budgets together and put them into what we call the master budget. Okay, started with sales, and then it moved down into the individual department areas. Yeah, and then it moved down to creating the cash budget, etc. But that was the whole idea. Got everyone together, we created the budget. As the year went on, I would compare month to month what we budgeted and where we actually were. And I do that for each line item. But compare the budget to the actual. And then based off of what would happen, we'd make modifications. Okay? Like for example, that big reservation that the hotel had, they're not going to come in no more. They canceled their reservation, whatever. So that's a reduction in revenue. Reduction in revenue means I need to reduce my expenses for that month, right? Taking action. And then I do the same process again for every single year. Okay, that's the way it worked in my business. That's the process, right? So what are the benefits of doing something like that? Well, it helps us to focus on what's going on in our business, right? It gives us a plan. We're focusing on future opportunities and potential threats. It provides control to the business. I'm able to look at what I forecasted, my budget, and where I'm actually coming in at. I'm comparing it. And that's giving me control, right? It's saying, here's the amount I expected. Here's where it came in. I'm able to control it, right? Make adjustments where needed. It helps us to work as a team when I got everyone together, right? We're coordinating the effort. I got everyone involved, all the managers are working toward a similar goal. It opens the lines of communication with each other. It helps the different management from different departments to all get together and act as a team, right? And it's also a motivating kind of thing. It gets everyone on that team motivated to do what's best for their department and for their employees, all working toward that common goal. Helps us to attain and succeed our benchmarks, our performance metrics. Yeah. So all those things together are the benefits of creating a budget. Now, here's the thing when you got a bunch of different managers together. Everyone's kind of got their own personality. And, sometimes it can be real interesting. You get a bunch of managers in the same room. Some don't get along with each other. Some feel competitive. Some feel like, they're on the same team, but maybe their motives might be a little different. Call these human behavioral factors. Behavioral factors, when it comes to money, can be real interesting. You know what I mean? Like, people are motivated to do things when it comes to money. You might work a little harder because you want more money, right? You're motivated in a good way, right? Oh, I'd like a little bit more sales commission. So therefore, I'm going to work a little harder. I want a bigger bonus this year. I'm going to work a little harder, okay? Those are good things, positive motivating factors. Here's my goal. It's challenging. I can make that goal. And when I make that goal, I'm going to do well, right? Motivating, positive behavioral factor. Those are all good things. Employees are affected by the budget, especially those that help to prepare it. Motivating factor. All good things. But there's also that not so good side when it comes to budgeting, that behavioral factors. Some employees, when they go in, with pressure, there might be pressure to do things, It's like, this goal is really tough. That's in the budget. This sales goal is really tough. So I might, make up a couple numbers here and there. Well, that's fraud and that's unethical, okay? But it's a negative part of human behavior that comes from budgeting. The second one here, this one really makes me upset. Employees might understate their sales goals, budgets, and overstate their expenses to allow for a cushion. Oh, I hate cushions. I don't like that. Most people don't like that. You might be wondering to yourself, well, Dr. B, it's nice to have a little cushion, right? What if something goes wrong? Got to have a couple extra dollars. No, that's not good. That's not good for budgeting. Why? Here's why. When you understate your sales goals and overstate your expenses, you're creating room for error. Creating room for people to be sloppy. People to not hit their goals because, they're too easy, or they're able to hit their goals because it's too easy. And they're not thinking about the actual expenses and what that means. When you're budgeting for every dollar. Okay? So having a cushion is not a good thing. You don't want that cushion. Why? Because you could have allocated those dollars somewhere else. So having cushions is bad.
Professor?
Leland.
I was wondering, because you said having a cushion is bad. Is that the same for in the context of an individual? Like, say, for example, of course, you have emergencies and stuff like that. So people might, for their personal budget, might allow for stuff like that or have a cushion.
Yeah,
Would you
for
still
your
have that same idea for that as a, because this seems more
it's
like in the
bad.
context of like a business,
It's
like it's
bad.
just bad all around.
It's bad personally as well, and here's why, Leland.
Oh, yeah.
Because that's a good question. You should have an emergency fund in itself, okay, separate from your checking account. You see what I'm
Good point.
saying?
You should
So,
already have one
so
anyways.
like, right. So, like, that money's already there for an emergency. You know, see what I'm saying? So, like, if you know how much is coming into your household every month, and you know how much is going out of your household every month, you shouldn't be left over with all this extra fund money at the end of each month.
So basically, cushions just create like a reason to spend money on stuff
It
you don't really
creates a
need.
reason to
Basically,
waste it. Exactly.
exactly. I
Exactly.
get your point.
You see what I'm saying? So like you want to have that separate emergency fund, okay, separate savings account or whatever's, but it's got to be separate from your regular checking, okay? Like good rule of thumb, have $1,000 emergency fund. Okay, why? Because it seems like everything these days that's an emergency is like $1,000, right? So you want to have that $1,000 set aside for your emergency fund, because you never know when you're going to need it. You want that separate. You want that separate from your checking account because it's there for emergencies. Now, if you're fortunate enough of a person where you're at the end of every month, you got some left over. You know, you got your what you're getting in from your employer minus your monthly household operating expenses. That includes, groceries, fuel, um, etc., clothing, etc. The rent, the utilities, all that jazz. So what you got coming in from your employer minus all those line items for your household. At the end of the month, if you got several $100s more left over, that's good for you. But don't just treat that like a slush fund or whatever. You want to tell that money where to go. You got to have a budget. And so with that budget, you tell that money what to do. Use that extra money you have left over to pay off any kind of debt that you might have. Credit card debt, student loan debt, whatever other debts. Use that extra money to pay those things off. Don't just let it be that tool, right, for you to go do things you might not should be doing. Or have a separate account for saving up for vacations or whatever. But the point here, Leland, to the discussion is that you want to keep those things separate. It's not good to have that cushion in personal or in business.
Thank you.
You're welcome. Good conversation. The last thing, I also hate this last one too. Employees might spend budgets on unnecessary items to ensure the budget's not reduced next year. This sounds like the government to me. This makes me upset. Oh, if any of you works for the government, I am so sorry for what I'm about to say, but I'm not going to be nice here for a second. All right. So let me just get this out my system. There's nothing more that upsets me the most than to see the government wasting our tax dollars on things that are unnecessary just so they can get the same amount next year. It pains me to say things like this. It does. But the government's notorious for wasting our money. All right? That's our money, our tax dollar money that the government likes to waste every single year. Now, yes, a lot of things are very necessary. They spend money on necessary things, okay? Education, infrastructure, defense, fire, police, etc. All very important things, and yes, we need those things. But then they go doing stupid things like we gave the defense department, all these billions of dollars, and then they go do something stupid like buy golden toilet seats that cost $1 million a piece just so they can get the same amount of money next year. That makes me angry. Okay, so
Don't politicians get in trouble for stuff like that nowadays?
they should be. The problem there is that there's just not enough oversight when it comes to the government spending. There's not enough watchdogs, there's not enough oversight. There's just not enough people to say, hey, maybe you shouldn't be spending money on things like that. So, but yeah, I'll get off my high horse. I'm sorry. I apologize. That kind of stuff drives me nuts. Same thing happens in business, right? They have a certain budget. They want to spend all that money because they want the same amount next year. Don't do that. That's silly. That's wasteful. Yeah. Save the company the money, right? Maybe the company will be cool and pay it out in a bonus later on. So you don't know, but just don't waste money. So those are all behavioral human things that we need to talk about, because I don't know if I said this before in this class, but finance is 80% behavioral. It's only 20% book knowledge. What I mean by that is that, everything we do financially in this world, whether that's personal or in business, a lot of it's driven off of human behavior. It's not necessarily, it's most of the time it's a good thing, but there's that little percent that's not so great. So there's something to be aware of. Okay. When it comes to budgeting, I prefer a continuous budgeting cycle. What that means is I have a full budget of 12 months in front of me, regardless of what's happening. Call it a rolling budget. So, for example, here we are in the month of October. October's just wrapping up. We got a couple days left in October. And so what that means is that I've already built my budget for October 2025. October 2025, my budget's done for the company. Why do I do that? I want to make sure I have a continuous 12 months of budgeted expenses in front of me. So when November 2024 ends, I'm going to have November 2025 budgeted out. When December 2024 ends, I'm going to have December 2025 already in the budget of continuous 12 months in front of me. Call that a rolling budget. It's important to have a good amount of time budgeted out in front of you. Usually a full 12 months, we call that a rolling budget. I always revise my budget as time passes, okay? Make small adjustments incrementally where necessary. Remember, the budget is the plan. The plan is the budget. You want to have 12 months of plan. Let's talk about the master budgeting process from a manufacturing perspective. I told you how it worked in the hotel business. It all started with sales. Then I had all my individual departmental budgets. All that rolls into the full operating budget. And from the operating budget, I can figure out my selling and administrative expenses, my capital expenditure budget, and my cash budget. The same concept applies in manufacturing. Here's how it looks. Every budget starts with sales. I need to know how much sales I expect to make for the year in order to drive the budget forward. Otherwise, I don't know. The same is true for your household budget. Your budget starts with how much net income you have coming into the household. Your net pay. Your net pay amounts for the month is going to drive your household budget. in business, it's sales. Sales drives our budgeting process. Based off of our sales budget, how many units I expect to sell times the sale price, okay, total sales budget, that will drive my production budget. Based off of the number of units I expect to sell, I can figure out how many units I need to make, right? I got this in inventory already, so that's my beginning balance, plus the amount I expect to have at the end of the year, my ending balance. The difference is how many I need to make, okay? Production budget. Based off of knowing how many units I need to make, I can figure out how much materials I need, raw materials I need to buy. I could figure out how many hours it's going to take to make that number of units. How long it's going to take to make those number of units. I get my labor budget from that. Hourly rate times the amount of time it's going to make the number of units. And my overhead budget. You know, obviously I got a production line going here. I got my lights, I got, utilities, supervisor salaries, indirect materials, etc. Factory overhead. The production budget drives direct materials budget, direct labor budget, and factory overhead budget. Once I have all of that information together, then I could figure out my cash budget. The cash budget's derived from how my customers are going to pay me. They're going to pay me mostly in cash and some through credit, accounts receivable, or what, right? What am I going to collect that cash? So that's the cash coming in. And then, of course, I got cash going out of the business for the purchase of the materials, the payment of my employees, and the payment of my overhead, right? So all that drives my cash budget. On the sides, an offshoot from sales, we also have what we call capital expenditure budget and selling administrative expenses budget. On the capital expenditure side, capital expenditures, when the company wants to expand or improve, capital expenditure. I'm going to purchase property, plant, and equipment, capital expenditure. On the selling administrative expense side, that's paying my sales commissions to my salespeople, that's paying my shipping for the purchases, etc. You see? So all of that drives the cash budget. Together, we call this the master budget. In this lesson, this lecture, we're going to use an example from a hockey stick manufacturing company based out of Toronto, Canada. Very fitting since we're in hockey season. It's October, hockey season. Yeah, it's getting cold out, so we'll talk about hockey. All right. So here we have some data from our hockey stick manufacturing company in Toronto, Canada. Here's our balance sheet. We got cash, $20,000, accounts receivable, $25,200. I have raw materials, the wood to make the hockey sticks. I currently have 178 pounds of it at $20 per pound. I have finished goods inventory. I have 1,010 hockey sticks already created at $17 per stick to make. I got equipment worth $200,000. Accumulated depreciation on that equipment $36,000. So value of the equipment $164,000. Total assets $229,930. And then of course I got my liabilities and equity. I got some accounts payable, bills I got to pay. I got to pay some taxes. I got a loan I'm paying back. And I got some equity, common stock, retainer, etc. Okay, so that's our balance sheet. Reason why it's important to know the balance sheet before we get started on the capital budgeting process, more specifically, is because I need to know how much cash I have on hand, how much cash I expect to collect from my customers, how much raw materials I already have, and how much finished goods inventory I already have. Why are those things important? Because we're going to create the production budget, you see. So, as I had mentioned, the budgeting process starts with sales. We need to know how much our expected sales are going to be. Here I have the fourth quarter of data for the company. The fourth quarter, the last 3 months of the year. October, November, December. We expect to make 3,200, or expect to sell 3,200 hockey sticks. We expect to sell 3,200 hockey sticks for the last quarter of the year. And we sell each hockey stick at $60 a piece. The 3,200 times $60 a piece gives us a total sales budget for the fourth quarter of the year of $192,000 in sales. Okay, great. Across the 3 months, I can figure out an estimate of how many units I expect to sell for each month. October, I'm going to sell 1,000. November, I'll sell 800. December, I'll sell 1,400. Okay? The number of units we expect to sell times the sale price gives us the total budget sales for each month. Typically, you want to do this for the whole year, but to keep things easy, we're just going to look at the last quarter of the year. So that's my sales budget. 3,200 units at $60 per unit is $192,000 total sales estimated for the fourth quarter of the year. Now, based off of my sales budget, I can figure out how many units do I need to produce. Okay? The way I do that is I'm going to take my budgeted ending inventory plus my budgeted sales units minus my beginning finished goods inventory. Remember the balance sheet I showed you. The balance sheet is going to show us the beginning finished goods inventory. Okay? Beginning finished goods inventory, I think we said was 1,010 units, right? So the number of units to produce, we take ending inventory from the prior month plus the budgeted sales in units minus the beginning finished goods inventory. Okay? So, having said that, looking at our example, we have the following pieces of information for October, November, December. We take the budgeted sales, October, 1,000 units, plus we have the desired ending inventory. The way we find desired ending inventory is we oftentimes look at how much we want to end the month with. Reason why you want to have some at the end of the month is obviously because you want to be able to sell some for the following month. So in this example, the company says we want to have 90% of our future sales to be our desired ending inventory. So we take the next period budgeted sales units times the percentage desired ending inventory to equal the desired ending inventory in units for that month. In this case, 800 units we're going to sell in November times 90% that we're going to sell during the month equals 720 units desired ending inventory. So I take my beginning balance, we take our budgeted sales in units plus the desired ending inventory equals total required units minus the beginning inventory equals the number of units I expect to produce. So I want to sell 1,000 units in October plus the desired ending inventory of 720 minus the beginning inventory of 1,010. That means I need to produce 710 hockey sticks in the month of October in order to meet my sales goals. You see? I follow that same process for each month. Budgeted sales plus desired ending inventory minus the beginning inventory from the month equals the number of units I need to produce. See how that works? That's how we find the production budget. From the production budget, I can then figure out my direct materials, direct labor, and factory overhead budgets. To find the direct materials budget, I take the number of units I need to produce for each month times the amount of wood required for each unit, required materials for each unit, plus desired ending inventory for raw materials minus the raw materials beginning inventory. So again, very similar process to the sales. We got the number of units we need to produce from our sales budget times the raw materials needed for each unit, half a pound of wood per hockey stick, gives me my materials needed for production in terms of pounds. I'm making 710 hockey sticks in October. Times half a pound per hockey stick, that's 355 pounds of wood I need to produce the 710 hockey sticks. My desired ending inventory is 335 pounds of wood. How did I get that? It's half of the materials needed for the next month. Yep. I add my desired ending inventory to my materials needed for production to equal the total materials needed for the month. In this case, 690 pounds of wood, minus the beginning inventory for raw materials from our balance sheet of 178 pounds equals the materials I need to purchase for the month. I need to purchase 512 pounds of wood for the month of October. The current cost of a pound of wood is $20. So 512 times the $20 gives me a cost of direct materials purchases for the month of October of $10,240. I follow that very same process for every single month. That is the direct materials budget. As you can see, back at when we looked at the earlier chart, the sales budget drives the production budget. The production budget drives the direct materials budget, the direct labor budget, and the factory overhead budget. In looking at the direct labor budget. We take the number of units we need to produce times the amount of time it takes to produce each unit times the labor cost on a per hour basis. So number of units times time times amount per hour. In our example, this is much more straightforward. Number of units to produce comes from the production budget. 710 units in the month of October. How long does it take to produce a single hockey stick? A quarter of an hour. Quarter of an hour, 15 minutes. 0.25 of an hour is a quarter of an hour. A quarter of an hour is 15 minutes. So we take 710 hockey sticks produced times a quarter of an hour, 25%, equals 177.5 hours needed to produce the 710 hockey sticks. 177.5 times $12 per labor hour equals the total cost of direct labor, $2,130 for the month of October. I follow that same process for each month. It's just the 3 steps. Number of units times time times cost per hour. Very straightforward. That's direct labor. Factory overhead follows a very similar process. In this process, we take and separate out our variable from our fixed overhead. Variable overhead, as you know, is the cost of the product, essentially. Variable overhead. We got direct labor hours times the variable overhead rate per hour equals the budgeted variable overhead. So labor hours is our base, activity base, times our rate per hour, in this case $10 per hour. So we take 177.5 labor hours times the overhead rate per hour, $10, equals 1,775. The second step is we add in our fixed overhead rate. Fixed overhead is fixed. It doesn't change regardless of the level of output. It's the same for every month. In this case, 1,500. So 1,775 plus the 1,500 equals a total factory overhead budget for the month of October of $3,275. I follow that same process for every single month. Rolling on. We figured out our sales budget. The sales budget drove the production budget. The production budget drove the direct materials, direct labor, and factory overhead budgets. Now that I know all of these things, I can prepare my product cost per unit. How much it's going to cost me on a per unit basis to create a single hockey stick. It starts with your direct materials. From your direct materials budget, you know that it takes a half a pound per hockey stick of wood to make a hockey stick, yeah? Half a pound of wood to make a hockey stick. Times the $20 per pound means that I have a direct materials cost per hockey stick of $10. For direct labor, we know that it takes a quarter of an hour to produce one hockey stick. Quarter of an hour times $12 per hour, 0.25 times 12 or a quarter times 12, is $3 of direct labor per hockey stick. Then I have my variable and fixed overhead per unit. Takes a quarter of an hour to produce one hockey stick. That's my activity base. Times the $10 variable overhead rate gives me a variable overhead cost of $2.50 per hockey stick. Then I have my fixed rate, 1,500 per month divided by the number of units to be produced in that month. In this case, in the month of October, we're producing 1,000 hockey sticks. 1,500 divided by 1,000 is $1.50 fixed overhead for the month of October, giving us an average cost of per hockey stick of $17. Darius, I see your hand. Go ahead, Darius.
Yes. So I noticed that at the beginning of each quarter, the units produced are high. Is that a good method to use at the beginning if you want to produce when producing like units to make a profit?
Beginning. Okay. Okay. Let's go that. Let's go through that one more time, Darius. So, you said that you noticed that on average, the number of units to produce is by half.
No. At the beginning of each period, the units that are produced are higher, then it lowers, like in a 3-month span. Is
Mhm.
is that a good method to use after like every quarter?
It depends on the business. I mean, that's a great question. It depends on what it is that you're making. Um, think about a hockey stick, for example. When is going to be most of your sales? It's going to be October, November, December, and maybe January, February. But and you also got to think
Okay,
of,
yeah.
see what
Yeah, I
I'm
see
saying?
yeah, I see what you're saying.
And the
Yeah.
other and the other thing to consider there is when you're thinking about that is think about what months you make most of your sales in, right? So think about the month for example. October, it's probably gonna be a slower month for selling hockey sticks, you would think, because it's not as cold just yet. November, the reason why we didn't sell as much is because look at November. I mean, you got a bunch of holidays, probably be closed down, might not make as much sales. December is going to be a real busy month. People are buying more hockey sticks for Christmas gifts and, et cetera. So that's why you see that level of fluctuation in terms of your sales. Now, because your sales amounts are fluctuating like that, that's going to translate to a fluctuation in the number of hockey sticks you need to make for each month.
Okay.
Does that make
So
sense?
it depends on what you're selling. Yeah. I
Depends on
get
what you're
you.
selling. Yeah,
Okay.
exactly.
All right.
Yeah, it depends on what you're selling. Exactly. Great question. Great question. Okay, so we went through the process. We talked about the sales budget. Sales budget drove the production budget. Production budget included the direct materials budget, direct labor budget, factory overhead budget. Now we figured out the cost per unit on a per unit basis. Okay, $17 per unit. That's how much it costs per hockey stick. Now we can create what's called the cost of goods sold budget. And that's a very simple process. We take the number of units we expect to sell during that month and multiply that by the cost per unit. Makes sense. Month of October, I expect to sell 1,000 units. Cost me $17 to make a single hockey stick. 1,000 times 17, 17,000. I go through that same process each month. That helps me to create my cost of goods sold budget. The reason why we want to know our cost of goods sold budget is because we need to figure out on the other side of that chart, remember, we have our selling and administrative expenses budget. When it comes to sales, some companies, they pay their employees a commission, okay? A commission basically is a motivational tool for people to sell, right? It's like, oh, I'll sell more of that product if you give me a little, little skin in the game, little action on that. So it's like, okay, I'll sell your hockey sticks, but you got to pay me a little bit more, or a little commission. That'll help me to drive more sales. That's why we create this, what we call a sales expense budget. And then really there's two parts of this. A company might have your commission people, but you're also going to have your salaries for your sales manager. Yeah. So it's really that variable and fixed. The variable is the commission. The fixed is going to be the manager. So here we have an example. We expected to sell $60,000 worth of hockey sticks in the month of October, right? Where do we get that from? Well, we're selling each hockey stick, we're selling it at $60, remember? And we're selling 1,000 of them in the month of October. That's where 60,000 came from. So 1,000 hockey sticks at $60 per unit, that's $60,000 in sales in October that we expect to make. We pay our employees a 10% commission on each hockey stick that they sell. So we take the 60,000 total sales times 10%, that's $6,000 in sales commissions that we're going to pay out to our employees. We also have a manager. A manager's salary is fixed. It does not change regardless of the level of output. Their salary per month is $2,000. So commission $6,000 plus the salary of $2,000 gives us total selling expenses for the month of October of $8,000. We do follow that same process for every single month. That's our sales budget. Included in that area, we have our general and administrative expenses. These are your other things like your office personnel salaries and, office type expenses like computer, software, paper, supplies, shipping materials, etc. And we usually treat this as a flat type of expense. So every month is the same amount. Okay, so now that we've created all these budgets, right? Our sales budget drives our production budget. The production budget drives the direct materials budget, the direct labor budget, the factory overhead budget. And all that drives the cost of goods sold budget, the selling and administrative expense budgets, and we're getting down to the bottom, right? The cash budget. But before we get to that cash budget, we also have on the left side of that chart, we got the capital expenditures budget. As I had mentioned, capital expenditures budget helps the company to grow. This is the purchase of property, plant, and equipment in order to grow the company, to invest in the company. That's what we call a capital expenditure budget. We're saving money to spend, to invest, to grow the business. That's real simple. That's a real simple budget. When are we going to purchase this new equipment? And how much is it going to be? We put it in. Now we have all cash budget. The cash budget is based off of a couple of different factors. Number one, we're looking at our current cash balance. We got that from our balance sheet, remember? And I think it was like 20,000 or something like that. That sounds right. So that's how much we had in the bank, 20,000. Plus our budgeted cash receipts. Some of our customers will pay us in cash over the counter, and some of our customers will pay us through accounts receivable on credit, right? So customers come in, they purchase the hockey sticks right there in the store. Other customers, they'll purchase a bunch of them and they'll pay us over time. Accounts receivable, you see. So we got to figure out when they're going to pay us our budgeted cash receipts. So we got our cash balance plus our budgeted cash receipts minus our cash payments that we need to make. Remember, we got to run the business. I got to purchase raw materials, the wood. I got to pay our employees $12 an hour to make the hockey sticks. I got to pay out my 10% sales commissions, my salary, and then, whatever else, day-to-day operating expenses. So cash balance from the balance sheet, plus the expected cash coming in, over-the-counter sales plus our accounts receivable, minus cash going out for the purchase of direct materials, paying our employees, other day-to-day operating expenses, equals our preliminary cash balance. Now, here's the thing. If the cash balance is good, meaning we got plenty of extra cash, sitting on our bank account, we can do some stuff with that. We can repay some loans, pay down our debt. If we don't have enough cash coming in, then we need to take out a loan, short-term loan to cover that gap. But that's what the cash balance formula is for. So we follow that very simple formula to establish our cash budget. It might be a little bit more challenging than it looks, and that's because we got to look at the timing of our cash receipts. Our customers don't always pay us in cash over the counter, do they? Some of them might be on accounts receivable, so we got to factor that in. Now, the way that we do that is we figure out what percentage of our customers are cash customers and what percentage of our customers are accounts receivable customers. Okay? And when we expect to collect on that account receivable. Okay? So we figure for our business, about 40% of our customers pay us in cash over the counter, and the other 60% of our customers pay us on account receivable. Okay? So the way that we factor this is we take our total expected sales from our sales budget, and we multiply that by the percentage. 40% cash, and then 60% credit. Real simple. So, now here's the thing. That 60% credit, that stems from the prior month's sales. Right, the prior month. 40% I'm collecting just simple cash. The 60% is from the previous month. So it's going to mess with the timing, you see. So here we have the example in October. In October, I expected to sell $60,000 worth of hockey sticks. 40% of that is $24,000. Okay, simple. That's easy to figure out. The 60% is from the prior month. In September, I sold $42,000 worth of hockey sticks. 60% of that is $25,200. See where we're going, right? So my total collection of cash for the month of October is $49,200. 40% cash customers and 60% from the prior month of sales, account receivable. So my expected cash income for the month of October is going to be $49,200. I follow that same process for November and December.